How are you all doing? Welcome to today's class. So today we are going to finally complete chapter number 4, that is price determination in different markets. Hi everybody, how are you all doing? All good? Are we ready for today's class? Give me a thumbs up in the chat box. Yes. Are we ready for today's class? Hello, Raghavendran. Yes, dear students, are you all there? Quickly give me a reply in the chat box. Ready, ready, ready. Do we have any doubts from the previous chapter that we have completed? Are there any questions that you want to ask me from the previous chapter? Hello, Monica. How are you? All right. I believe we should start with this chapter. The name of the chapter is price determination in different market. So whenever we use the word market, market has elements like existence of a buyer and seller. There should be existence of a product or a service. There should be a bargain over price. There should be knowledge about the market conditions and one price of a product or a service at a given point of time. So a market is an arrangement whereby buyers and sellers come in close contact with each other for buying and selling goods and services for a price over which they can bargain. Hello Surya, very good evening Nandini, very good evening Surya. So whenever we talk about market, please understand that market in economics is not based on a place, but it is defined on the basis of commodity. So there is a fish market, there is a vegetable market, there is a flower market, there is a furniture market. So in economics, market is not defined on the basis of place, it is defined on the basis of commodity. So we call it as a commodity market, gold market, silver market, diamond market. Now market on the basis of number of sellers. So can I say this is a type based on competition, and competition is based on number of sellers. So if there is single seller, we call it as monopoly. If there are two sellers, we call it as duopoly. If there are few sellers, we call it as oligopoly. If there are many sellers, we call it as monopolistic competition. And if there are large number of buyers and sellers, then we call it as perfect competition. Yes, everybody. So when I talk about perfect competition, there are two competitions. One is perfect competition, another is imperfect competition. Perfect competition, we call it as a price taker. So firm in a perfect competition is a price taker. Firm in a imperfect competition is a price maker. Under perfect competition, we get total revenue curve as a linear curve. Total revenue curve is rising at a diminishing rate, or rather I should write constant rate. Therefore, we call this curve as linear. Absolutely correct, Nandini. Whereas under imperfect competition, we get a non-linear curve. Initially, total revenue rises at a diminishing rate. Then at this point, it becomes maximum or constant. And then it falls. Then there is a concept called as marginal revenue and average revenue. Since they are price takers, AR is equal to MR, the demand curve, supply curve of an industry, determine the price, and that price is accepted by the firm. Whereas under imperfect competition, MR falls, AR falls, but MR falls at a faster rate. So before I draw the MR curve, we should know that when TR is maximum, MR is 0. So this should be our marginal revenue curve. Marginal revenue is positive, total revenue rises at a diminishing rate. Marginal revenue is 0, total revenue is maximum or constant. Marginal revenue is negative, total revenue falls. Absolutely correct, Surya. Can I say perfect competition? These are a few features. Homogeneous products, same prices. This is your AR curve. So under perfect competition, price is equal to AR is equal to MR. Whereas under imperfect competition, MR is lesser than AR. Yeah, are we all clear with this? Are we aware that in a perfectly competitive market, we cannot determine price, we can only determine output? Whereas in an imperfect competition, if I determine price, I cannot determine output. If I determine output, I cannot determine the price. What is the formula for total revenue? Total revenue is summation of marginal revenue. The formula for marginal revenue, rather another formula for total revenue is P into Q. Absolutely correct, Surya. Surya, are we clear till here? Now, marginal revenue of N is equal to TR of N minus TR of N minus 1, or marginal revenue is delta TR upon delta Q. The formula for average revenue, that is per unit, TR upon Q. But beta, TR can be written as P into Q. So AR becomes P into Q upon Q. Q, matching. Therefore, AR is equal to price. So whether it is perfect competition or imperfect competition, we always say that AR and price are the same. Yes, dear students, are we all clear? Do let me know in the chat box. Absolutely correct, Surya. But you need to add one more word, that is monopolistic competition. Because when you write only monopolistic, it means a monopoly. When you write competition, then it becomes large number of sellers with similar products. Yes, Surya, Nandini, Monica, Ravendra, are we all clear? Do let me know in the chat box. Shall I go ahead? Is there a doubt that you have in this concept? Any questions, any doubts, any difficulties? Let me know in the chat box. So, revenue are of three types: total revenue, average revenue, marginal revenue. Surya is clear, Nandini is clear. What about others? Raghavendra is also clear. That's wonderful. So what are the features of perfectly competitive market? In perfect competition market, there are large number of buyers and sellers. There is no transportation cost. The firm is a price taker. They sell homogeneous product. Homogeneous means perfect substitutes, or homogeneous can mean identical products. So example of perfect competition is agricultural goods. Since they are perfect substitutes, the demand is perfectly elastic. And if demand is perfectly elastic, E is equal to infinite, which means the demand curve is a horizontal line parallel to x-axis. And hence, beta, over here if you see, the AR curve is the demand curve. Correct, Surya. But can I say this is an unrealistic concept? Perfect competition does not exist in the real world. A smaller brother of perfect competition is pure competition. Under pure competition, there are only three assumptions or three features: large number of buyers and sellers, free entry and free exit, and single uniform price. Yeah, are we clear? Yes, dear students, can I have a reply in the chat box regarding are we clear or not? So the next part that I'm moving to is called as profit maximizing level of output. Which is also called as, absolutely correct Surya, it is also called as equilibrium level of output. Under this we use MRMC approach. Correct Surya. MR stands for marginal revenue, MC stands for marginal cost. We can study this concept under perfect competition as well as under imperfect competition. Under perfect competition, MR curve is a horizontal line, whereas under imperfect competition, it is a downward sloping curve. So this is my MR curve perfect competition. This is my MR curve imperfect competition. MC curve is a U-shaped curve. So will I produce where the cost is higher than revenue? In the red color area that I have marked, the cost is greater than revenue. And if the cost is greater than my revenue, then I will not be operating at this red color area. Will I produce at point A? The answer is no, because I have not even tasted profits. Will I produce at point B? Definitely, because I have collected the entire profits. इसका भी लेगा, उसका भी लेगा, जिसका मिला, जैसा मिला, सबका लेगा. I will produce till point B and my output will be Q because I have collected entire profits. Since this is a marginal concept, will I produce at A? No. Will I produce at B? Yes. So at point B, what do I observe? Number one, MR is equal to MC. Absolutely correct, Raghvendra. And MC curve should cut the MR curve from below. At point A, the MC curve cuts from above. At point B, it cuts from below. So Raghvendra, as you rightly said, we should produce at point B. Are we clear, dear students? Yes, everybody. So how many conditions are there? There are two conditions. Condition number one, MR should be equal to MC. Condition number two, MC curve should cut the MR curve from below at its or from below. Or MC curve should have a positive slope. Or MC curve should be rising. Yes, dear students. Are we all clear? So the name of the concept is equilibrium level of output or profit maximizing level of output. PMLO. LMNOP? PMLO, profit maximizing level of output. Yes, dear students, are you all there with me? Are we understanding? Are we all clear? Shall I go to the next part? Raghvendra is clear. Absolutely correct. So, beta, there is a concept called as a relationship between MR, AR and elasticity of demand. So the formula is MR is equal to AR into E minus 1 upon E. So if E is greater than 1, which means E is equal to 2. So 2 minus 1 upon 2 is equal to 1 by 2. Therefore, over here, MR is positive. When MR is positive, TR rises at a diminishing rate. Then we can say E is equal to 1. So 1 minus 1 upon 1 is equal to 0 upon 1, which means answer is 0. When MR is 0, TR is maximum. And E can be less than 1, which means E is equal to 0.5. So 0.5 minus 1 upon 0.5 is equal to minus 0.5 upon 0.5, which is equal to negative. So when MR is negative, TR falls. Yes, Surya, I hope we are clear. Now for profits, I repeat, for profits, we have a concept called as AR and AC approach. AR curve is called as price curve. AC curve is called as cost. So cost is equal to, profit is equal to price minus cost. So dear students, for profits, we use AR and AC approach. Suppose if the cost of manufacturing one projector is 20,000 Average fixed cost is 8,000. Absolutely correct, Raghavendra. And the variable cost is 12,000. So what is the minimum cost that I have to bear? I repeat, what is the minimum cost that I have to bear? Yes, Surya. Whether I produce or I don't produce, I will have to bear fixed cost. So if I give you a possibility, case, AR, AC, comparison, and whether there are profits or loss. So in case number 1, my revenue is 30,000. My cost is 20,000. So AR is greater than AC, which we call it as super normal profits or abnormal profits. So have we recovered our variable cost? Have we recovered our fixed cost? Yes. And upon that we have additionally earned 10,000. So such a profit is called as super normal profit. Absolutely correct, Surya. Then case number 2, I am earning 20,000. My cost is also 20,000. So AR is equal to AC, which means the profits are 0. But in economics, we study accounting cost as well as explicit, implicit cost. So in this 20,000, there is explicit as well as implicit. So we call this profit as 0 economic profit, or we call it as normal profit. So when AR is equal to AC, 20,000 minus 20,000, answer is 0. So there are two types of profits. If I have to explain you that, suppose if my total revenue is 1 lakh, my explicit cost is 70,000. Explicit costs are those costs which are recorded in the books of accounts. Implicit cost is equal to 10,000. So I can calculate two profits. One is accounting profit. Accounting profit is equal to total revenue minus total cost, only explicit, because we have used the word accounting. Yes, Ravindra. Yes, Surya. Absolutely clear. So my total revenue is 1 lakh. My total cost is 70,000, which is my explicit cost. Therefore, my accounting profits are is equal to 30,000. Now there is a cost or a concept which is by the name of economic profit. Economic profit is also total revenue minus total cost, but explicit plus implicit both. So my total revenue is 1 lakh. minus my total cost is 80, 70 for explicit, 10 for implicit. Excuse me. Therefore, my economic profit is rupees 20,000. So if you observe, my economic profits are less because my costs are more, whereas my accounting profits are more because my costs are less. Therefore, accounting profits are greater than economic profits, or economic profits are lesser than accounting profits. So whenever we study economics, we study only explicit. No, we study explicit, implicit, both. So such profits are called as zero economic profits. Yeah, are we clear? Have we understood? Any questions, any queries, any doubts? Now, the third possibility is I am earning 15,000 as revenue. My cost is 20,000. So my average cost is greater than average revenue. But I am able to recover my variable cost. So AC is greater than AVC is greater than AC greater than AR. AR is greater than AVC. So this is called as subnormal profit. Not only am I able to recover my variable cost, but I am also able to recover some part of fixed cost. So if I would have stopped the production, yes, Surya, if I would have stopped the production, my loss would have been 8,000. Because fixed cost needs to be borne, whether you produce or not. But if I continue to operate, if I continue to produce, then my revenue is not only able to recover my variable cost, but it is also able to recover some part of my fixed cost. Now in the fourth case, I am only able to recover my variable cost. So AC is greater than AR, but AR is equal to AVC. When AC is greater than AR and AR is only equal to AVC, we call it as maximum variable loss. If I continue to operate, my loss is 8,000. If I stop my production, still my loss will be 8,000. Therefore, is there a need for me to bear a loss over and above my fixed cost? No. The maximum loss that a producer should bear is the fixed cost. The producer should at least recover his variable costs. So as long as the producer is able to recover his variable cost, he should continue to produce. As soon as the producer is not able to recover his variable cost, he should stop producing, which will happen in case number 5. Suppose if I earn only 11,000, my revenue is 20,000, cost is 20,000. So AC is greater than AR, but AR is less than AVC, which means my revenue is not able to recover my variable cost. My variable cost is 12,000, but I have recovered only 11,000. So such a point is called as shutdown point or shutdown position. Absolutely correct, Surya. So are we all clear? Have we understood? Any questions, any doubt? Do let me know in the chat box. Yes, the implicit cost is the opportunity cost, so we are correct. If variable cost recover, he can produce. That is also correct. Are we all clear? Kindly reply in the chat box saying yes, understood. The conclusion, as long as the producer is able to recover his variable cost, continue to produce. As soon as the producer is not able to recover his variable cost, it's time for the producer to shut down. Surya has understood. Ravindra, Nandini, Shivani, Kamal, Faridul, Deepika. That's wonderful, Deepika. So beta, in case number, this diagram is a point where AR is greater than AC in a perfectly competitive market. On the, this is my price, this is my cost. So AR is greater than AC, we call it as supernormal profit. Over here, AR is equal to AC, we call it as normal profits. And over here, AC is greater than AR, we call it as losses. Nandini is also clear. That's wonderful. In the long run of a perfectly competitive market, the producer earns normal profit because of free entry and free exit. Because a producer ideally wants to earn supernormal profit, but because the producer, there is competition in perfect competition, the competition will increase. A rise in competition will lead to a fall in profits. So few producers will start making normal profits. If more people enter, then there will be subnormal profits. Now at subnormal profits, few people will leave the market, and therefore producers will again earn a normal profit. So in the long run of perfect competition, we always earn normal profits. Are we all clear? Now, when I talk about monopoly, monopoly will earn supernormal profit because there is no free entry and free exit. Absolutely correct, Surya. So when we talk about monopoly, we say that monopoly is a single seller. The firm is the industry. There are entry restrictions. The cross elasticity of demand is zero because there are no substitutes available to a monopoly. There is absence of substitutes or no closed substitutes. And beta, when there are no closed substitutes, the demand is relatively inelastic, which means E is less than 1, which means the curve is a steeper curve. Yes or no? Monopoly is a price maker, he is a price discriminator, charging different prices to different consumers for the same commodity. So if you see the diagram, this diagram we can observe AR is greater than AC. This is your AR curve, this is your AC curve, this is price, this is cost. AR is greater than AC. There can be losses also. So the second diagram is AR is less than AC or AC is greater than AR. In the long run, as Surya rightly said, the producer will earn supernormal profit because there are barriers to entry. There is no free entry and free exit. Yes, dear students, is there anything that you have not understood? Do let me know in the chat box. Are we all clear? Have we understood? Now, similarly, as I told you, there is price discrimination, charging different prices to different consumers for the same commodity. Then there is monopolistic competition. Monopolistic competition, we sell differentiated products. Differentiated products are also called as similar products, or they are called as heterogeneous. So toothpaste industry, soap industry, biscuit industry, all these are examples of monopolistic competition where there are large number of buyers and sellers, there is free entry, free exit, there is a product differentiation. Now, since there are close substitutes which are available, the demand is relatively elastic, which means E is greater than 1, which means the curve is a flatter curve. So in monopoly, we get a steeper curve. In monopolistic competition, we get a flatter curve. Yes or no? Are we understanding? Are we not understanding? So the first diagram that you see over here, AR is greater than AC. The second diagram, AR is less than AC. Yes, Nandini, absolutely correct. Surya, large number of sellers selling similar products, not identical. Identical is used in perfect competition. So, perfect competition, identical products. Monopolistic competition, similar products. Yes, Nandini, monopolistic competition is a combination of monopoly and perfect competition. And in this diagram, we see that AR is equal to AC, so we get normal profits. So perfect competition and monopolistic competition are similar in the long run because both of them earn normal profits because there is free entry and free exit. Hello everybody, are we understanding? Are we clear? Are there any questions? Are there any doubts? Have we understood everything? If there are any questions, queries or doubts, do let me know in the chat box. Can I help you with some question? Now there is an oligopoly. Oligopoly market is a market where there are few sellers. Then there are types of oligopoly. One is perfect oligopoly, other is differentiated. Perfect oligopoly is for homogeneous product. Imperfect oligopoly is for heterogeneous or differentiated product. Then B is open oligopoly or closed oligopoly. Open means entry is allowed, closed means entry is restricted. Absolutely correct, Surya. Collusive oligopoly. Collusive or competitive. Collusive means there is common understanding. Competitive means lack of common understanding. Collusive means they are like friends. Competitive means they are like enemies. Partial and full oligopoly. Under partial oligopoly, one firm is dominating and other firms will follow. Whereas under full oligopoly, all the firms are equally dominating. Then there is syndicated or organized. In a syndicated oligopoly, the sellers will sell their output via agent, via syndicate. Whereas in an organized oligopoly, they will sell their output via themselves, not taking any help of a agent. So there are 5 combinations: perfect oligopoly, imperfect oligopoly, open oligopoly, closed oligopoly, collusive oligopoly, competitive oligopoly, partial oligopoly, full oligopoly. Syndicated or organized. Coke and Pepsi are examples of oligopoly. So aviation industry, telecommunication industry, cold drink industry are examples of oligopoly, where there are few sellers, there is a lot of interdependence, there is an advertising cost, and we have a kinged demand curve. The king demand curve, the above party is flatter and the below party is steeper. So under this concept, we have price rigidity. We should neither increase our price nor should we decrease our price. We should maintain the price P, and this is called as your kinged demand curve. Yes, dear students, are we clear with that? Have we understood? Are there any questions, queries, or doubts? And with that, we are done with chapter number 4. That is price determination in different markets. King demand curves are under oligopoly. Absolutely correct. So I am sure that you all have come with a lot of doubts. If not, then you all should start solving the MCQs from the ICI material or the material that you prefer. And I will start taking your doubts in some time. Now the forum is open for everybody to ask any doubts from any chapter. Chapter 1 to chapter 10. If you have any questions, any queries, any doubts, you can let me know. So first of all, can I have a reply in chat box saying that chapter 4 is clear to everyone? Quickly, everybody. Are we clear with chapter number 4? Have we understood everything? Is there anything else that I can help you with? Surya, Nandini, Bilateral monopoly means there is a single seller and there is a single buyer. Seller is also one, buyer is also one. Then such a concept is called as bilateral monopoly, where the buyer and seller are only one. So single buyer, single seller is a concept of bilateral monopoly. Yes, Surya, are we clear with that? Anything else, Surya? Any MCQs? Any questions? Everybody, Raghavendra, Nandini, and you can ask me questions from any chapter. Now you can let me know which are the other concepts that you want me to revise. Now that I am done with the entire microeconomics chapter 1, 2, 3, 4, 5, you can post your doubts related to anything and everything. So I'll wait here. I'll be there observing the chat box. If I get any doubts, I will be asking you and I will be solving your doubts. These are a few MCQs which I have displayed on the screen, which you can try to solve on your own. If you are unable to solve, you can let me know. I will solve those doubts for you. In this chapter, there is another concept called as equilibrium price. I hope we all know how prices are determined. It is the intersection of demand and supply curves. Demand can increase, demand can decrease, demand can go to the right, demand can go to the left. Supply can increase, supply can decrease, supply can go to the right, supply can go to the left. So there are multiple possibilities which are a part of your unit number 2, price determination under perfect competition. Partially, I have covered this concept in chapter number 2, where if demand is greater than supply, there is scarcity. In scarcity, the prices will rise. Demand is less than supply, there is surplus. Therefore, in surplus, the prices will fall. Remember that AR curve is the demand curve, MC curve is the supply curve. Not the entire part of MC curve, but that part of MC curve which is above the variable cost curve is the supply curve. Because as a producer, we should be able to recover our variable costs. So if a producer is able to recover his variable costs, it is only that part of MC curve which is considered as your supply curve. So AR curve is the demand curve, MC curve is the supply curve. So on in ICIM material, there is page number 4.24. This is not a solution. These are the 4 questions. You can try to solve these. Yes, Surya, in fiscal reforms, what are your doubts? The fiscal reforms are related to the taxes and the expenditure, the fiscal policy of the government. Government of India reduced the direct taxes, indirect taxes, abolished a lot of taxes. These are fiscal reforms, Surya, where income tax rate was brought down, customs duty was brought down, corporate taxes were brought down, anything and everything which were related with taxes. The government of India reduced all the taxes. So if you want, you can take a photograph of this and start solving this. These are not solutions, these are 4 questions. You have to answer these. It is on page number 4.24. And since Surya asked me about fiscal reforms, I go to Indian economy, where there are fiscal reforms. So first is stable and transparent tax structure, tax compliance. Curbing government expenditure means reducing government expenditure, reduction in subsidies, selling government assets, that is disinvestment, and encouraging the private sector participation are few of the fiscal reforms, Surya. Anything specific, Surya, that you have a doubt in, do let me know in the chat box. I have displayed the questions that you are supposed to solve. Nandini, Deepika, Raghavendra, feel free to ask your questions. Same goes to Surya as well. Surya, are we clear with fiscal reforms? Okay, Surya, let me know if there is any other question. Let me know, Surya, if there is anything else that I can help you with. I hope you are able to, everybody who is attending this is able to solve these 4 questions. These are not solutions, these are the questions. I repeat, there is a printing error in ICAI. Very simple. Surya, personal income is the income of the household, whereas disposable personal income is the income left after paying taxes. So if I earn rupees 1 lakh, that is my personal income. But from that I need to pay tax. So personal income minus income tax is called as disposable personal income. Yes, Surya. I hope you are clear with this one as well. Let me know in the chat box if I can help you with this concept any further. If not, this next concept in which you have a doubt. Anybody else? Beta, only Surya is asking doubts. Nandini, Raghavendra, Kamal, Faridul. Which theory do you want me to explain, Surya? There are 5 theories. Mercantilist theory, absolute advantage, uh, relative advantage, HO theory, or the new trade theory. There are 5 theories. Mercantilist theory is zero sum game, where only one country wins, other country loses. Exporting country only exports, importing country only imports. The exporting country sells goods and services, and in return it gets gold and silver. So only one country gets benefited. In new international trade theory, beta, this theory is applicable for monopolistic competition. Under monopolistic competition, this theory is divided into 2 parts. One is economies of scale and one is the network effect. Economies of scale lead to a lower per unit cost. So low cost, low price model. So countries should focus on that commodity in which they can have huge economies of scale. Because of economies of scale and large scale production, per unit cost will fall down. Because per unit cost falls down, your price also falls down. So international trade helps you to achieve economies of scale. And the other one is network effect, which is a bandwagon effect. Because people will use an iPhone, I am also willing to use an iPhone. Bandwagon effect is a copycat effect where I imitate the consumption patterns of others. So Surya, in new trade theory is applicable to the monopolistic competition. Under monopolistic competition, the theory further gets divided into 2 parts. One is by the name of economies of scale. The other is by the name of network effect. So this is your new trade theory. Because of economics of scale, cost per unit keeps going down. Whereas network effect is the value of the product or service is enhanced by the number of individuals using it increases. It is called as bandwagon effect. Consumer like more choices, but they also want products and services with high utility, and network effect offers increased utility from these products over others. A good example of that is WhatsApp or softwares like Microsoft Windows. Yes, Surya. I hope we are clear with this one. Waiting for your next doubt. I hope everybody is able to solve this question that I have displayed. Okay, Surya. Next out, please. Nandini, if you have any doubts, let me know. In comparative advantage, one country has advantage in producing both commodities, one country has disadvantage in producing both commodities. Still, according to Ricardo, we should do international trade. So suppose this is based on the assumption of 2:1. Two countries, country A and country B. There are two commodities, X commodity, Y commodity. Country A can produce X units in a number of hours. So if I say in 1 hour, country A is able to produce 6 units. Whereas country B is able to produce 1. Country A is able to produce 4 units of Y. Country B is able to produce 2 units of Y. So tell me which country has an advantage in both the commodities. Which country has an advantage of producing both the commodities X and Y? Country A. Which country has disadvantage in both? If country A has advantage in both, which country has disadvantage in both? Yes, Surya. Quite a simple answer. Correct. So, in such a situation, you might feel that international trade is of no use because country A has advantage in both, country B has disadvantage in both. So, Ricardo believed country should produce that commodity in which the disadvantage is less. Country A has advantage in both, but lesser disadvantage in X. Country B has disadvantage in both, but lesser disadvantage in Y. So A and B countries should do international trade. A should focus on X commodity and B should focus on Y commodity. And this concept was given by Ricardo, where there are two countries, two commodities, and one factor of production. Do you want me to explain this further in detail, or have you understood? So according to Ricardo, countries should do international trade by focusing on that commodity in which the relative disadvantage is less. That's wonderful, Surya. In exam, they can ask you a reverse question. 1x is equal to, or rather, 1 unit is equal to x hours. So you will have to be very careful and read the question carefully, whether they have given units to hours or hours to units. Chalo, if there are any other doubts, let me know. If there is any other student who has a doubt, let me know. The alone man standing is Surya. So, beta, customs, economic and monetary union are types of regional trade agreements. Custom unions are those unions where there is free entry and free exit, where there is a free trade between the countries and they follow an same or external tariff to others. Common external tariff. So under customs union or customs union concept, there is free trade amongst member nations and they follow a common external policy, common external tariff for non-members. In economic and monetary union, the level of integration increases. Free inflow and outflow of goods, free inflow and outflow of services, free inflow and outflow of humans, free inflow and outflow of capital. Free trade amongst countries for goods, services, people and capital. And they have common external tariffs for non-members. Plus, in an economic and monetary union, the currency can also be the same. Central bank can also be the same. Example is a European Union. Under European Union, they have only one currency, one central bank. That is an economic and monetary union, Surya. Nandini has a doubt in countervailing duties. So Nandini, these are tariffs in response. There are two types of tariffs in response. One is anti-dumping, one is countervailing. So suppose you are in the US, you are a farmer in the US, the government of USA provides you subsidy on producing apples. Now because of the government subsidy, you are able to sell those apples in India at a lower price. Then what does the Indian government do? To offset the benefit given to you by the US government, the Indian government will charge a tariff which is called as a countervailing tariff or a countervailing duty to offset the subsidy given by government of one country. The other country's government will charge a tariff which is by the name of countervailing duty. Yes, Surya. Are we clear with customs and economic monetary union? Nandini, are we clear with countervailing duties? Do let me know in the chat box. If there is any further help that I can do, you can ask for it. Do not worry. You can tell me to explain again. You can tell me to give few more examples. I don't know. So Surya, revaluation and appreciation are the same, except revaluation is done purposely by the government, whereas appreciation is done by demand and supply forces. So when the government of India announces $1.84 to become as $1.83, this is revaluation. When the government interferes and tells Whereas when $1 is 84 and it becomes $1.83 due to demand and supply forces, then it is called as appreciation. So revaluation is a purposeful activity of the government, whereas appreciation is on the market forces. I hope Surya I am clear. Let me know. Understood, sir. Thank you, Nandini. If there is anything else, let me know. Okay, Surya, that's wonderful. Next out, Surya, Nandini, Raghavendra, Kamal, Faridul, Shivani. So Surya, as I explained you earlier also, free floating is demand and supply forces. Fixed exchange rate is government. And managed float is government will interfere only after a certain point. So free float and fixed exchange rate are two extremes. Under fixed exchange rate regime, the government or the central bank will determine the exchange rate. Under free float, it is the demand and supply forces. Whereas under managed float, it is the demand and supply forces. The government will interfere only if they feel the need to interfere. So for example, the Indian government can say that if the foreign exchange rate fluctuates beyond the 2%, then I will interfere. If it is in the range of 2%, I will not interfere. So free float, no interference of the government. Fixed exchange rate, complete interference by the government. And managed float is partial intervention by the government. Okay, Surya. Are we clear? Anything else? If not understood, let me know. If understood, then also let me know. Okay, Surya. Next doubt, please. Arbitrage. Arbitrage is buying in one market and simultaneously selling it in another market. So arbitragers buy and sell at the same time, but in different markets. So I have purchased a foreign exchange in Indian market, but I have sold that foreign exchange in UK market. So the difference that I earn is called as arbitrage. People who do arbitrage are called as arbitrageurs. So they earn a very small profit per unit, but they deal in lakhs and crores. So eventually they are someone who earns lots and lots of. So arbitrage is a process of buying a currency in one market, selling it in another market. So I don't know whether you have observed, but in NSE and BSE, National Stock Exchange and Bombay Stock Exchange, there is minor difference of 0.05 paisa, 0.01 paisa. Similarly, in foreign exchange market also there is this small margin. Yes, with an intention to earn profits, but buying and selling is done simultaneously. So you buy right now, you sell right now. It's called as an arbitrage. Are we clear, Surya? Hedge. Hedge means to cut the risk. So hedging is a process where you are trying to reduce your risk. So in foreign exchange market, we can hedge foreign exchange. So I have entered into an agreement to purchase foreign exchange, but I am not sure whether I am exposed to a risk. So to reduce the risk, I will enter into another agreement which will reduce my risk. I don't know whether you know betting by any chance. In cricket, IPL, there is betting. Now when you bet, suppose if you have betted 100 rupees and you are going to get 1000 rupees if your bet is correct, but you are not sure that what you have predicted is exactly what is going to happen, then what will you do? You will hedge yourself. You will take a contract which is opposite of the one which you have already taken. So you have betted 100 rupees that Chennai will win. But what is the guarantee that Chennai will win? So you enter into an agreement, another agreement where you say Chennai will not win. So you reduce your risk. When you reduce your risk, it is called as hedging. So this you will be learning in detail in FM in future. So there are a lot of concepts related to this. So you must have heard about options, futures, swaps, currency swaps. All these are hedging instruments. Hedging reduces your exchange rate risk. It is a protection against adverse movement in exchange rates. Very simple, Surya. Greenfield and brownfield. Suppose you are investing in some country for the very first time. Greenfield investment. So I go to the US. I start my own manufacturing unit in the US. I am an Indian investing in US. A fresh investment is called as greenfield. Whereas if an investment is made in an already existing setup, then it is called as brownfield investment. So if I go to US and if I purchase Apple, entire Apple company, I purchase it and I make some additional investment, then it is called as a brownfield investment. So greenfield investments are fresh investments, whereas brownfield are investments into already existing investment structure. Next concept, next doubt. Yes, anybody, any other questions, any other doubts? Do let me know. If there are no doubts, then we are done for the day. That's it from my end. I think we have covered majority of the concepts. Lagging indicator, some event has occurred in the past whose impact is in the present. Whereas leading is some event has occurred in the present but impact is on the future. So lagging means there is a delay, whereas leading means it is in advance. So sales of the year 2023 is a lagging indicator. New order of plant and machinery or equipment is a leading indicator. Order is given in the present, impact is in the future. Concurrent is coincidental. I've already explained this while I had explained business cycles. So some event has occurred in the present, the impact will also be seen in the present, is called as concurrent. For example, inflation. If there is inflation in the economy in the present, the impact is seen in the present. If the price of petrol goes up today, the impact will be seen today. Retail sales, you sell it right now, you get money right now. Concurrent indicator, coincidental indicator. So there are three types of indicators: leading, lagging, coincidental. Leading means some event will occur in the present, economic variable change in the present, the impact will be in the future. This indicator moves in advance. Lagging indicator, the indicator has already been in the past, but impact is in the present. So there is a lag, there is a delay. And coincidental means abhi ke abhi, right now. So there is a change in the variable in the present. The impact is also seen in the present. Is called as a concurrent indicator. Yes, Surya, are we clear? Okay. Okay, Surya, then that's it for today. I don't see anybody else asking me any other doubts. Surya is done with his doubts. Nandini, Kamal, Shivani, Raghavendra, Monica, do we have any questions, queries, or doubts? If not, then that's it for today. Thank you so much. Please like, share, subscribe, comment, hit the bell icon. Bye bye. Anybody with any other questions, queries, or doubts? Most welcome, Surya. Thank you so much. I hope you have understood. Thank you, Kamal. Thank you, Nandini. All right, then. I think it's time to leave. I wish you all the very best for your exams. Go rock it. Make sure that you clear your exams in the first attempt. Ensure that you are conceptually clear. How do you go ahead about studies? First, clarify the concept, understand the concept, and then solve the MCQs. If there is no conceptual understanding, how will you solve the MCQs? So it is very important for you to first know the concept, then apply the concept and achieve the answer. Bye-bye, Surya. Bye-bye, Kamal. Bye, Nandini. Bye, everybody else in the YouTube live session for today. I wish you all the very best. May God bless you all. Thank you so much. Bye-bye.